Welcome back to Gold Rush Reporter, your trusted source for no-nonsense analysis on gold, silver, and the broader precious metals market. I'm Conrad, and today we're diving into a phenomenon that's shaking the silver market to its core. Prices are surging, supply chains are under unprecedented strain, and major developments are unfolding that most investors aren't aware of yet. If you've been watching silver this year, you know it's been a wild ride, and what I'm about to share will give you context that goes far beyond headline numbers. Let's start with the numbers. Silver has been hitting record highs, and today it briefly touched peaks near $93 per ounce. Some sources, like Kitco, underreport the intraday highs, but the real market action tells a different story. Triple digits in China, for instance, a milestone that has never happened before. Meanwhile, gold is climbing as well, hovering around 4,624 per ounce, close to its all-time highs, and the gold to silver ratio has fallen below 50, which is a signal for traders that silver is gaining strength relative to gold. These are not small moves. They are indicative of structural shifts in the market, not just a temporary rally. One of the most striking factors driving this momentum is retail and industrial demand. Dealers like Summit Metals are reporting record volumes, and the premiums on metals are reflecting the sheer pressure on supply. The market isn't just reacting to price speculation. It's responding to tangible shortages and operational bottlenecks across the industry. The fact that the US Mint has had to temporarily halt sales online because demand outpaces processing capacity underscores just how rare and extreme this situation is. Collector coins like Proof Eagles are now moving at or just above spot, which is something we haven't seen in years. Beyond supply pressures, geopolitical uncertainty is adding fuel to the fire. Investors are wary of events ranging from policy tensions in China to actions in Greenland, as well as domestic US developments like potential Fed rate adjustments. In Iran, demonstrations and instability continue, which adds a layer of global uncertainty that drives precious metals demand as a hedge. Simply put, buyers aren't just reacting to market charts. They're responding to global risk, and silver benefits from both industrial and safe haven demand. For retail investors, this presents unique challenges. Many dealers are overwhelmed, with extended ship times and, in some cases, minimum order restrictions, creating hurdles for smaller buyers. At the same time, savvy participants can use these conditions to their advantage, understanding that temporary delays or premium spikes don't reflect a market collapse. They reflect a market transitioning to a new structural reality. The lesson here is patience and strategy. The metals are moving fast, but it's the forces behind these moves that matter most. This rally isn't just about hitting round numbers. We are observing fundamental shifts in supply, industrial usage, and global monetary policy that are redefining silver's trajectory. Whether it hits $100 per ounce this month or shortly thereafter, the important takeaway is that demand, both retail and industrial, is outpacing supply in a way that makes these price levels plausible and sustainable in the short term. In the following parts of this series, we will break down exactly what's happening behind the scenes at major dealers, the implications of halted US Mint sales, and how these supply pressures could reshape premiums and access for both institutional and retail investors. We'll also explore the broader macroeconomic factors influencing silver and what that means for long-term positioning. So, if you've been watching silver soar and wondering whether the momentum can continue, stay tuned. We're about to unpack the realities of this historic run in the next segments, explaining how to navigate these turbulent times with insight, discipline, and strategy. As we continue, it's crucial to understand that silver's surge isn't happening in isolation. The current momentum is supported by both industrial demand and investment demand. creating a perfect storm for higher prices. Over the past several years, silver has consistently faced a supply deficit, with global production unable to keep up with growing industrial usage, especially in electronics, solar energy, and medical technologies. Unlike gold, which is primarily an investment and hedge asset, silver's dual role as an industrial metal gives it unique upward pressure when markets tighten. This combination of scarcity and necessity is a driving factor that many new investors overlook. We're also seeing unprecedented stress on bullion dealers. Companies like Summit Metals are reporting heavy order volumes and operational bottlenecks. Orders are delayed, staff are working extended hours, and some dealers have even implemented minimum purchase requirements for certain products to manage the flow. While this may frustrate retail buyers, it reflects just how acute the supply-demand imbalance has become. The market is proving that silver isn't just a speculative asset. It is being treated as a strategic, high-demand commodity by serious investors and industrial users alike. Understanding this distinction is essential for anyone considering exposure at current price levels. The dynamics of the market are further amplified by global financial uncertainty. Investors are increasingly turning to precious metals as a hedge against inflation, currency devaluation, and geopolitical instability. Recent events in China, for instance, have spurred massive demand, pushing silver into triple-digit territory on the Shanghai Gold Exchange, a historical first. Meanwhile, US and European markets are reacting to the prospect of interest rate changes, political tensions, and economic indicators that, in many cases, have less impact than the psychological effect they create on investors' risk appetite. The volatility we are seeing is not irrational. It is a rational response to a confluence of supply constraints and macroeconomic uncertainty. From a retail investor's perspective, this environment calls for careful planning. Simply chasing the price spikes without understanding the underlying structural forces can be dangerous. The market has demonstrated rapid intraday swings, with silver moving several dollars in hours, yet these movements are part of a broader repricing process. Temporary pullbacks or delays in fulfillment are not signals to sell. They are the market recalibrating to a new reality. By analyzing trends like the silver-to-gold ratio, international premiums, and dealer availability, investors can better position themselves to participate effectively without being caught off guard by temporary disruptions. Another key factor is the behavior of institutional participants and sovereign buyers. Central banks, major funds, and industrial users have a long-term perspective and can absorb short-term market shocks. Their accumulation strategies amplify upward pressure on price while ensuring that volatility remains contained within a broader structural trend. Retail investors need to recognize that, while sudden spikes or dips grab headlines, the larger, ongoing accumulation by these sophisticated participants is what ultimately drives sustainable price movement. It's also worth noting that price reporting platforms often lag actual market conditions. In many cases, reported highs and lows do not fully reflect intraday trading or international markets. Today's silver prices, for instance, exceeded what some sources indicated, highlighting the importance of monitoring multiple data points and being aware of market anomalies. These discrepancies emphasize that informed investors must look beyond surface-level numbers and understand the real forces at work: industrial demand, geopolitical tension, supply chain constraints, and sovereign accumulation. Finally, the rapid pace of change in the silver market underscores the importance of timing. Those entering the market now are navigating a transition from a long-standing period of relative stability into one of structural revaluation. Unlike typical trading environments where moves are gradual, this shift is occurring swiftly and with high intensity. The window to act effectively is narrow, and strategic planning, patience, and situational awareness are crucial. As silver continues its remarkable climb, the strain on dealers and fulfillment networks is becoming more visible. Even well-established companies are facing bottlenecks, with shipping delays and limited stock affecting both retail and wholesale buyers. Some bullion dealers have introduced minimum order thresholds or temporarily disabled pre-sales for certain high-demand products. These measures, while frustrating for individual investors, are a necessary response to unprecedented demand and limited inventory. They highlight just how fragile the supply chain can be when a metal transitions from relative obscurity to mainstream attention in such a short time frame. For retail buyers, this environment requires strategic thinking. The traditional approach of buying and holding without regard to supply constraints is no longer sufficient. Investors must account for delivery times, product availability, and potential premiums, which can fluctuate sharply during periods of high demand. The historical parallels are instructive. In prior bull runs, similar supply bottlenecks emerged, resulting in temporary price surges and delays in fulfillment. Today, these pressures are magnified by global demand and the rapid dissemination of information, which allows investors worldwide to react instantly to market shifts. One major development is the divergence between US domestic prices and international markets. Silver has recently surpassed $100 per ounce on the Shanghai Gold Exchange, creating arbitrage opportunities and adding to market complexity. While domestic prices lag slightly due to reporting delays and logistical constraints, savvy investors are monitoring international exchanges to gauge the true supply-demand balance. This disparity also underscores the growing interconnectivity of global markets. Price movements in one region can rapidly influence sentiment and trading behavior elsewhere, particularly when markets are thin or highly leveraged. Industrial demand remains a critical driver behind silver's momentum. Beyond investment interest, silver is integral to the production of solar panels, electronics, medical devices, and other high-tech applications. Companies cannot simply pause or reduce consumption without risking operational disruption. Consequently, even when prices rise sharply, industrial demand remains inelastic, providing sustained support for the metal. This dual demand, industrial and investment, creates a structural underpinning for the current rally that differentiates it from speculative bubbles seen in other asset classes. In addition, macroeconomic factors continue to fuel uncertainty-driven demand. Geopolitical tensions, potential changes in US interest rates, and shifting trade dynamics between major economies are prompting investors to seek safe haven assets. Precious metals, particularly silver and gold, are increasingly viewed not only as hedges against inflation, but also as protection against systemic financial risk. This is reflected in the shrinking gold to silver ratio, indicating silver is gaining relative strength as a monetary and industrial metal simultaneously. Supply constraints are another critical factor. Primary silver production constitutes only a fraction of global output, with a significant portion coming as a byproduct of mining other metals. As a result, increasing supply quickly is nearly impossible, even if prices soar. Projects to expand production require years of planning and investment, meaning short-term surges in demand cannot be met with immediate increases in supply. Retail investors and institutions alike must account for this structural limitation when evaluating their entry points and position sizes. Another layer to consider is dealer strategy. Larger firms, including both established and newer players, are adjusting their operations to maintain service standards while coping with demand spikes. Extended work hours, reallocation of staff, and prioritization of essential products are becoming common. Investors need to recognize that fulfillment delays are not necessarily a reflection of market instability, but rather an operational response to unprecedented demand. Awareness of which dealers are capable of meeting orders reliably can make a significant difference for both short-term and long-term planning. Finally, This period represents a learning moment for retail investors. Traditional assumptions about liquidity, pricing, and supply reliability no longer apply. Silver is moving into a new reality where structural factors, industrial demand, sovereign accumulation, international arbitrage, and supply constraints drive price more than day-to-day market sentiment. Understanding these dynamics is critical for making informed decisions rather than reacting emotionally to headlines or temporary pullbacks. As we move deeper into the current precious metals rally, the interplay between market dynamics and geopolitical uncertainty becomes even more apparent. Silver's recent surge is not occurring in isolation. Global events are shaping investor behavior and creating extraordinary conditions for price movements. Political unrest, supply chain disruptions, and policy uncertainty are all amplifying the metal's appeal as both a hedge and an investment. Investors are increasingly aware that traditional financial instruments may not offer the same protection as tangible assets like silver and gold, especially when global volatility is elevated. One notable factor influencing the market is the continued supply-demand imbalance. Silver remains in deficit relative to industrial and investment demand for the sixth consecutive year. Industrial consumers, from electronics to solar panel manufacturers, cannot afford interruptions in supply, meaning that even significant price increases do little to dampen demand. This structural limitation underscores why silver behaves differently than purely speculative assets. While gold may serve primarily as a monetary hedge, silver carries a dual role, a monetary and industrial asset, which compounds its scarcity effect during rallies. Meanwhile, dealer constraints are increasingly shaping investor experience. Major bullion dealers have introduced minimum order thresholds and delayed shipping timelines to cope with overwhelming demand. These measures, though frustrating for individual buyers, signal the seriousness of the rally and the operational challenges faced by the market. Smaller dealers are also adjusting, but many cannot match the logistical scale of larger firms, leading to regional variations in availability and premiums. This is a critical lesson for investors. The ability to access physical silver at reasonable terms is not uniform, and patience and strategy are essential. International markets are also contributing to volatility. With silver surpassing $100 per ounce on the Shanghai Gold Exchange, arbitrage opportunities have emerged, and domestic prices are adjusting in response. The bid-ask spreads have widened, reflecting both increased market activity and logistical strain. For investors, this illustrates that tracking multiple exchanges and monitoring global supply-demand conditions is more important than ever. Price movements are no longer local phenomena. They are the result of global interactions among industrial demand, sovereign purchases, and retail speculation. Geopolitical risk continues to be a major catalyst. Tensions in the Middle East, shifts in US foreign policy, and economic uncertainty in major economies are driving demand for precious metals. Investors are treating silver not only as an industrial commodity, but also as a strategic reserve in an unpredictable environment. This duality explains why even short-term disruptions, like order delays or supply bottlenecks, fail to meaningfully depress the market. The metals are increasingly seen as insurance against instability, rather than mere trading instruments. Another key factor is the role of sovereign and institutional accumulation. Central banks and large institutional investors are quietly adding silver and gold to their holdings, recognizing the long-term structural value of these metals. This creates a base level of demand that is less sensitive to daily price swings, supporting the market during periods of retail-induced volatility. As a result, even when smaller investors panic sell during short-term pullbacks, the broader upward momentum remains intact. This environment is shaping investor strategy in real time. Rapid price moves, record high premiums, and supply delays are teaching the market that patience, timing, and diversification are critical. Investors who understand the difference between short-term speculation and structural demand are better positioned to navigate volatility. Buying during minor pullbacks and focusing on reliable dealers can improve acquisition prices while avoiding unnecessary risk. Finally, silver's current trajectory highlights the unprecedented nature of this market cycle. The combination of industrial demand, geopolitical uncertainty, and structural scarcity is driving price action unlike anything seen in decades. Retail and institutional investors alike are witnessing a market that moves in rapid, sometimes chaotic bursts, yet is grounded in solid fundamentals. Understanding this context is essential for anyone serious about participating in the precious metals sector. As we wrap up our analysis of silver's remarkable 2026 rally, several key takeaways emerge for investors navigating these unprecedented conditions. First, the dual nature of silver as both an industrial and monetary metal is creating a market unlike anything seen in recent decades. The combination of structural scarcity, rising global demand, and geopolitical uncertainty has created a surge that is not purely speculative. Unlike meme-driven or short-term bubbles, this rally is underpinned by tangible supply constraints and long-term industrial necessity. Supply chain limitations remain a critical factor. Major dealers are struggling to meet unprecedented demand, instituting minimum order thresholds and longer fulfillment timelines. Retail investors are facing delays of several days or even weeks, which underscores the intensity of market pressure. While this can be frustrating for individual buyers, it is a clear signal that the rally is real and structurally supported. Smaller dealers may step in to fill gaps, but they cannot match the scale or reliability of established firms, meaning careful planning is essential for those looking to accumulate silver at favorable terms. Global pricing disparities are also shaping the market. With silver trading above $100 per ounce in Shanghai, while domestic US prices are slightly lower, arbitrage and international demand are creating volatility in spreads. Investors must pay close attention to these dynamics, as local premiums and availability can vary significantly depending on region and dealer. Monitoring multiple markets and understanding how geopolitical and economic factors affect global supply is increasingly important for anyone serious about investing in precious metals. Geopolitical risk remains a major driver. Ongoing instability in the Middle East, tensions in US foreign policy, and economic uncertainty in China and other major economies are pushing investors toward tangible assets. Silver and gold are being treated as insurance against monetary and political uncertainty, which explains why price declines during minor pullbacks are often short-lived. The metal's dual role means that industrial demand, sovereign accumulation, and investment demand all combine to create strong structural support for prices. Institutional accumulation is quietly reinforcing the market. Central banks and large institutions are steadily adding silver to their reserves, recognizing both its scarcity and strategic value. This creates a base level of demand that is resilient to short-term volatility, supporting upward momentum even when retail activity is erratic. For individual investors, understanding the difference between structural and speculative demand is critical to forming a long-term strategy. Buying opportunistically during small corrections, rather than chasing prices, will generally yield a better average cost over time. This period also illustrates the importance of patience and discipline. Rapid price swings, widening bid-ask spreads, and dealer constraints may feel chaotic, but they reflect the underlying market reality rather than irrationality. Those who understand the fundamentals, supply scarcity, industrial demand, geopolitical risk, and sovereign accumulation, can navigate the volatility with confidence. Relying on short-term news, social media hype, or panic-driven market sentiment will often lead to suboptimal decisions. Looking forward, 2026 is shaping up to be a defining year for silver. With global supply pressures, increasing industrial demand, and elevated geopolitical risk, we could see silver surpass $100 per ounce domestically while continuing to push record highs internationally. Investors should remain aware of shipping delays, minimum order requirements, and regional pricing variations, while keeping an eye on how macroeconomic events influence long-term trends. Finally, the lessons for any precious metals investor are clear. Focus on structural factors, understand the dual nature of silver, plan purchases strategically, and monitor dealer availability carefully. Silver's current trajectory is unprecedented in modern history, and those who approach the market with knowledge and patience will be best positioned to benefit from the ongoing rally. As always, remain disciplined, stay informed, and keep your investment decisions grounded in both market fundamentals and global context. Thank you for following along with this analysis. Stay alert for updates on precious metals and continue to monitor the market carefully. Your informed decisions today can make a significant difference tomorrow. Remember to like, comment, and subscribe to Gold Rush Reporter for the latest insights and early access to critical developments in gold and silver markets.